Welcome, financial heroes. BitMan here, ready to guide you on this stock market journey. First things first, we need a reliable trading platform. Just as a knight needs a sturdy steed, we need a platform that's user-friendly and intuitive. For beginners, Robinhood is a solid choice. It's simple yet comprehensive, making it perfect for those starting their investing journey. Robinhood offers a clean interface, easy navigation, and a wealth of information at your fingertips. It's like having your own digital command center for the stock market. Now, why is choosing the right platform so crucial? Well, it's our gateway to the financial world. It's where we'll conduct trades, monitor the market, and make informed decisions. So fire up your engines and sign up on Robinhood. It's the first step on our investing adventure. Now, our journey needs fuel. It's time to fund our account. We're going to connect our bank to the trading platform, Robinhood, and transfer some funds over. This is like packing our bags before a big adventure, except instead of clothes and toothpaste, we're packing dollars. To do this, you'll need to go to the account settings and find the option that says Link a Bank Account. Follow the prompts, enter your bank details, and voila, you're linked up. Now we're ready to transfer some funds. Remember, it's not about how much you're transferring, but about getting your feet wet. You could start with $100, $50, or even $20. The goal here is to learn the ropes, not to become a millionaire overnight. So go ahead, choose an amount you're comfortable with. This isn't just a deposit, it's your first step into the world of investing. Remember, we're here to learn. So, let's get started. Next, we scout for potential allies. Let's pick a company to invest in. Now, the stock market is littered with options, but it's crucial to invest in what you know and believe in. For instance, let's consider Apple, a tech titan with a reputation for innovation and consistent growth. When we talk about researching a company, we're not just talking about reading the latest news or checking out their products. We're also talking about a deep dive into their financial health. This might sound daunting, but don't worry, it's not as complicated as it seems. First, look at the company's earnings reports. These are released quarterly and annually. They contain a wealth of information about the company's revenue, net income, and earnings per share. These numbers give us a snapshot of the company's financial health. Next, consider the company's debt. A company with too much debt might struggle to grow or even stay afloat. Look for the debt-to-equity ratio, a handy little number that tells us how much debt a company has compared to its equity. Then, look at the company's price-to-earnings ratio, or PE ratio. This tells us how much investors are willing to pay for each dollar of the company's earnings. A high PE ratio could mean that the stock is overpriced or that investors are expecting high growth. Finally, consider the company's future prospects. Are they innovating? Are they expanding into new markets? Do they have a strong leadership team? These are all crucial factors in a company's long-term success. Of course, you also want to keep an eye on the stock's price trends. Look for patterns and indicators of when to buy or sell. For instance, a dip in the stock price might be a good buying opportunity. Remember, investing is not just about buying low and selling high. It's about believing in a company's future and being willing to ride the ups and downs. Choose a company you believe in and start researching. Knowledge is power in the stock market game. Market's down today. Perfect time for us to strike. Let's buy our first stock. Now, you might be wondering, why buy now? Well, in the stock market, a dip often presents a golden opportunity to buy shares at a discounted price. It's like snagging your favorite pair of shoes on sale. Who doesn't love a good bargain? So how do we go about this? Let's use our previous example of Apple. On your Robinhood dashboard, type Apple into the search bar. You'll see a detailed overview of the company's performance. Don't be intimidated by the jargon and numbers. We're here to demystify them. You'll notice a graph with green and red bars known as candlesticks. They represent the stock's price movement within a specific time frame. A green bar means the stock price increased during that period, while a red one indicates a decrease. But don't just focus on the colors. Look at the length of the bars. Longer bars mean larger price swings, implying higher volatility. As beginner investors, we want to tread carefully around volatile stocks. Just below the graph, you'll see the Buy button. Click on it and enter 1 in the shares field. Why just 1, you ask? Well, investing is a marathon, not a sprint. It's wiser to start small and gradually increase our positions as we gain more experience and confidence. Before you hit review, double-check the details. Make sure you're buying, not selling. Confirm that the company is indeed Apple and the number of shares is 1. Once all is in order, click Review, then Submit. Voila, you've just bought your first stock. Take a moment to bask in the excitement. It's a big step towards financial empowerment. But remember, the stock market is a roller coaster ride. Some days you'll be up, others you'll be down. It's all part of the journey. There you have it. You've made your first move in the stock market. Remember, dips are opportunities, not threats. So buckle up, keep learning, and enjoy the ride. Now, we set our sentinels. Alerts will be our guides. Like a lighthouse guiding ships in the dark, alerts in the stock market world help us navigate the often turbulent waters of investments. Imagine having a personal assistant who constantly monitors your stocks and notifies you when there's a significant price change. Wouldn't that be amazing? Well, that's essentially what alerts do. They keep a vigilant eye on the market, so you don't have to. Setting alerts is like setting up checkpoints on your financial journey. Let's say you've invested in a company. You'd want to know when the stock price rises significantly, right? That's a gain alert. On the flip side, if the stock price drops a certain amount, you'd want to know that too. That's a loss alert. Think of these alerts as your personal financial guardians, watching over your investments while you focus on other aspects of your life. They're your first line of defense, alerting you to significant changes so you can act promptly. But why 5%, you ask? Well, a 5% change in a stock's price is often considered significant. It's a standard threshold that many investors use. However, you can set your alerts based on your comfort level and investment strategy. Now, how do you set these alerts? It's quite simple. Most trading platforms, including Robinhood, allow you to set alerts directly from your account. You just need to specify the stock and the price change percentage. Once set, your digital assistant is ready to go. But remember, while alerts are incredibly helpful, they're not a substitute for regular monitoring and research. They're tools to assist you, not make decisions for you. So go ahead, set your alerts and let them do the work. They'll keep you informed of significant changes in your stocks, allowing you to make timely decisions. Set your alerts and let them do the work. Stay informed, stay ahead. One last step, heroes. It's time to reflect on our journey today. Just as a captain reviews his voyage, we too must assess our stock market adventures. Our decisions, whether they led to gains or losses, are our greatest teachers. Every choice we made today, from selecting a trading platform to setting alerts, is a stepping stone on our path to becoming savvy investors. What made us choose Robinhood as our trading platform? Was it its simplicity or something else? This reflection helps us understand our preferences and how they guide our decisions. It's not just about the platform. It's about what it offers that aligns with our investment goals. Then we fueled our account. The amount wasn't the focus, the act of taking a step towards investing was. Why did we choose the amount we did? Understanding our comfort level with risk is crucial in our investment journey. Next, we scouted the market. We chose a company we believed in, not just a random name. Why did we believe in it? Was it their products, their leadership, or their vision? This reflection helps us understand our investment philosophy. We purchased our first stock, seizing the opportunity when the market dipped. Why did we decide to buy then? Understanding market trends and our reaction to them is key to developing our investment strategy. We set alerts, our sentinels for when to act. Why did we set them at a 5% gain or loss? Reflecting on this helps us understand our tolerance for gains and losses. These reflections are not just thoughts, they're invaluable lessons. I encourage you to journal these reflections. Write about your actions, your thoughts, your fears, and your triumphs. This journal becomes a roadmap, guiding you through your future investment decisions. Remember, reflection is key to growth. Keep learning, keep growing. By understanding our decisions, we build financial wisdom. We turn from beginners into informed investors, ready to navigate the ever-changing tides of the stock market.